Hello! Welcome to Capital Sensei. Today, we're going to dive deep into one of the most essential skills for any investor, valuation. We'll be summarizing the key ideas from the Little Book of Valuation by the man many call the Dean of Valuation, Professor Aswath Damodaran. We'll break down the two major ways to value a company, figuring out what it's truly worth versus what it's priced at, and explore the tools you need to do it yourself, even if you're just starting out. Whenever we can, we try to answer questions left in the comments. So, as we go through this, if anything sparks a question, or if you have your own experiences with trying to value a stock, please share them below. Your insights and your doubts help everyone in this community learn and grow together. Let's get one thing straight right away. Valuation isn't some kind of mystical dark art reserved for Wall Street wizards in expensive suits. Professor Damodaran's core message is that valuation is a craft. It's a skill that can be learned, practiced, and honed. It's not about finding a single, magical, precise number. Instead, it's about creating a disciplined framework for thinking about what a business is fundamentally worth. Think of it like this. When you walk into a car dealership, you see a sticker price. That's the price. But is the car worth that price to you? To figure that out, you'd consider its condition, its mileage, how much you'll spend on gas and maintenance, and how long you expect it to last. Valuation is doing the exact same thing, but for a company. We're trying to look past the stock market's sticker price to figure out the car's real underlying value. Damodaran breaks down the world of valuation into two broad philosophies. The first is intrinsic valuation, which is all about determining the inherent worth of an asset based on its ability to generate cash in the future. The second is relative valuation, which is a bit more straightforward. It's about determining the value of an asset by looking at what the market is paying for similar or comparable assets. Let's start with the first and arguably more powerful approach, intrinsic valuation. The most popular tool for intrinsic valuation is the discounted cash flow model, or DCF. Now, I know that sounds intimidating, but stick with me. The concept is beautifully simple. Imagine you own an apple orchard. What makes that orchard valuable? It's not the land or the wood in the trees. It's the apples it will produce, year after year, for the foreseeable future. A DCF analysis is just a methodical way of estimating how many apples your orchard will produce each year, and then calculating what all those future apples are worth in today's money. In the world of business, the apples are cash flows. Specifically, we're interested in something called free cash flow. This is the cash that a company generates after it pays for all its operating expenses, and crucially, after it makes the necessary investments in buildings, equipment, and technology to keep the business healthy and growing. It's the leftover cash that could, theoretically, be paid out to all of the company's investors, both its stockholders and its lenders. It's the real spendable surplus. So the first step in our DCF journey is to become a fortune teller, but a disciplined one. We need to forecast these free cash flows into the future, typically for a period of 5 or 10 years. How on earth do we do that? We don't just pull numbers from a hat. We start by looking at the company's history. How fast has it grown its revenues and earnings in the past? Then, we look at the industry it operates in. Is it a fast-growing industry like cloud computing, or a mature, slow-moving one like canned soup? Next, we have to form a story about the company's future. This is the art part of valuation. What is its competitive advantage? Does it have a strong brand, like Coca-Cola, that allows it to charge more? Does it have a unique technology, like NVIDIA, that competitors can't easily replicate? Your estimate of future growth has to be tied to this narrative. A small, innovative company might grow at 20% a year for a while, but it's unrealistic to think a giant like Walmart will suddenly start growing that fast. Your story must be plausible. Okay, so we forecasted our cash flows for the next, let's say, 10 years. We have a stream of numbers representing the cash we expect the company to generate. But here's the catch. $1 you receive 10 years from now is not worth the same as $1 in your pocket today. Why? Because of risk and opportunity cost. You could take that dollar today and invest it, earning a return. And there's always the risk that the promised dollar in the future might never show up. We need a way to account for this. This is where the discount rate comes in. The discount rate is the interest rate we use to translate all those future cash flows back into their value today. It's our way of saying, how much less is a future dollar worth to me, given the riskiness of this particular company? A shaky, unproven biotech startup is going to have a very high discount rate because the risk of it failing is huge. A stable, predictable utility company that has been around for 100 years will have a much lower discount rate. The most common discount rate used is the weighted average cost of capital, or WACC. That's another term that sounds scarier than it is. A company funds itself in two main ways: by borrowing money, which is debt, and by selling ownership stakes, which is equity. The WACC is simply the blended average cost of that funding, weighted by how much of each it uses. It represents the minimum return the company must earn on its investments to satisfy both its lenders and its shareholders. Don't worry about calculating it by hand right now. The important thing is to understand what it represents: the riskiness of the investment. So, we take our 10 years of forecasted cash flows and we use our discount rate to pull each one back to its present value. Year 1's cash flow is discounted a little. Year 10's cash flow is discounted a lot more. We add up all these discounted values and we're getting close. But wait, what happens after year 10? A healthy company doesn't just fall off a cliff and disappear. It keeps going, right? This leads us to the final piece of the DCF puzzle, the terminal value. It's impossible to forecast cash flows in detail forever. So what we do is we make a simplifying assumption. We assume that after our detailed forecast period of 10 years, the company will settle into a mature phase and grow at a stable, perpetual rate forever. This growth rate is usually something conservative, like the long-term growth rate of the overall economy, say 2 or 3%. You can't assume it will grow faster than the economy forever, because then it would eventually become the entire economy, which is impossible. The terminal value often accounts for a huge chunk of the total calculated value of the company, sometimes more than 50%. This might feel a bit like voodoo, resting so much of the value on a single long-term assumption. And it's true, it's a big assumption. This is why your choice of that perpetual growth rate is so critical. A small change there can have a massive impact on your final valuation. It forces you to be realistic about the company's long-term prospects. So to recap the DCF process, we forecast free cash flows for 5 or 10 years based on a plausible story. We choose a discount rate that reflects the company's risk. We discount those cash flows back to today's value. Then we calculate a terminal value for all the cash flows beyond our forecast period and discount that back to today as well. We add it all up and voila! We have the total value of the company's operations, what's known as the enterprise value. But we're not quite done. We want to know the value per share of stock, right? The enterprise value is the value of the whole company, owed to both debt and equity holders. To get to the value for just the stockholders, or the equity value, we make a few simple adjustments. We subtract the company's debt, since that has to be paid back to lenders first. We then add back any cash the company has sitting on its balance sheet, because that cash belongs to the owners. After we have the total equity value, we simply divide it by the number of shares outstanding. And there it is. That final number is our estimate of the intrinsic value per share. We can now compare this number to the current stock price. If our calculated intrinsic value is, say, $100, and the stock is trading at $70, we might have just found an undervalued company. If it's trading at $130, it might be overvalued. Now that was a lot to take in. The DCF model is powerful, but it's also full of assumptions. Your valuation is only as good as your inputs for growth, risk, and cash flow. Damodaran stresses that the goal isn't to build the most complicated spreadsheet. The goal is to build a valuation that tells a coherent and believable story about the company's future. The spreadsheet just puts numbers to that story. Let's switch gears to the second major approach: relative valuation. If intrinsic valuation is like a detailed engineering assessment of a car, relative valuation is like checking the classified ads to see what similar cars are selling for. It's simpler, more intuitive, and it's what you hear about most often in financial news. It's all about comparing your company to its peers using standardized multiples. The most famous of these multiples is the price-to-earnings ratio, or PE ratio. It's calculated by taking the company's current stock price and dividing it by its earnings per share. A PE of 15 means you are paying $15 for every $1 of the company's annual profit. It's a quick and dirty way to gauge if a stock is cheap or expensive relative to its own history or relative to other companies in the same industry. For example, if most big banks are trading at a PE of around 12, and you find one that's trading at a PE of 8, your first thought might be, aha, this one's cheap. But hold on. This is where the real work of relative valuation begins. Damodaran warns us against the comparable trap. Just because two companies are in the same industry doesn't make them truly comparable. You can't just compare the PE ratios and call it a day. Why? Because the PE ratio is driven by three key factors: growth prospects, risk, and the quality of earnings. A company that is expected to grow much faster than its peers deserves to trade at a higher PE ratio. A company that is much less risky with stable and predictable earnings also deserves a higher PE. So, when you see that bank with a PE of 8, you have to ask why it's so low. Is it because the market has missed something and it's a bargain? Or is it because the company has serious problems? Maybe its growth is stagnant, or its loan portfolio is much riskier than its competitors. A cheap stock is often cheap for a very good reason. Your job as an analyst is to figure out if that reason is justified or if the market is overreacting. Besides the PE ratio, there are many other multiples we can use. There's the price-to-book ratio, or PB, which compares the stock price to the company's net accounting worth. This is often used for valuing banks and insurance companies whose assets are regularly marked to market value. There's the price-to-sales ratio, or PS, which compares the stock price to the company's annual revenue. This one is super useful for valuing companies that aren't yet profitable, like many young technology or biotech firms. After all, you can't have a PE ratio if you don't have any earnings. Another powerful multiple, especially for more mature or industrial companies, is the enterprise value to EBITDA ratio, or EV/EBITDA. Remember enterprise value from our DCF discussion? It's the total value of the firm. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a proxy for a company's operating cash flow before some accounting and financing decisions cloud the picture. This multiple is great because it allows you to compare companies with different debt levels and tax rates on a more apples-to-apples basis. The core principle of relative valuation is to find a group of truly comparable companies and analyze their multiples. If your target company is trading at a multiple significantly lower than its peers, and you can't find a good fundamental reason for it, like lower growth or higher risk, then you might have found an undervalued asset. But it requires you to be a detective, digging into the fundamentals that drive those multiples. So, we have these two major schools of thought. Intrinsic valuation, the DCF, tells us what a company should be worth based on its future cash generation. Relative valuation tells us what the company is priced at by the market, relative to its peers. Which one is better? Damodaran's answer is that you shouldn't choose. A good valuation uses both. They are two sides of the same coin and act as a check on each other. Imagine your DCF model tells you a stock is worth $100, but it's trading at $50. That looks like a screaming buy. But then you do a relative valuation and find that all of its peers are also trading at similarly huge discounts to their intrinsic values. This might tell you something important. Perhaps your entire industry is facing a headwind that your DCF model didn't fully capture. Or maybe the market is just deeply pessimistic about that sector right now. Conversely, if a stock looks cheap on a relative basis, say it has a PE of 10 while its peers are at 20, you should build a DCF model to see if that low multiple is justified. Does the company have underlying cash flow problems that warrant that discount? Using both methods gives you a much more robust and complete picture than relying on just one. It forces you to reconcile the long-term value story with the current market mood. One of the most important takeaways from the Little Book of Valuation is that valuation is a bridge between a story and the numbers. You can't just be a numbers person, plugging inputs into a spreadsheet without understanding the business. And you can't just be a story person, getting excited about a company's narrative without checking if that story holds up to financial scrutiny. A good valuation requires you to be both. Your story might be about how a company's new product will revolutionize an industry. The valuation process forces you to translate that story into concrete assumptions. How much will revenues grow? What will the profit margins be? How much will the company need to reinvest to achieve that growth? This process exposes the weak points in a narrative. It forces you to be honest about your assumptions and puts a price on your story. Damodaran also spends time explaining that you have to adapt your valuation model to the type of company you're analyzing. You can't use the exact same template for every single business. Valuing a young, high-growth company is a different beast from valuing a stable, mature one. For a young company, the story and the terminal value will dominate the valuation. The uncertainty is massive, so you might want to look at a range of possible outcomes instead of a single number. Valuing a financial service company like a bank or an insurer is also different. Their cash flow is tricky to define, and their balance sheets are their business. So for these, you might lean more on a dividend discount model, valuing the future stream of dividends, or a relative valuation using price to book value. For cyclical companies, like a car manufacturer or a mining company, you have to be careful not to value them at the peak of a cycle when earnings are artificially high, or at the bottom when they look hopelessly unprofitable. You need to normalize their earnings over a full economic cycle. Finally, Damodaran introduces a more advanced but fascinating concept: valuing assets with option characteristics. Sometimes a company's value isn't just in the cash flows from its existing business, but in its potential to do something new in the future. Think of a small pharmaceutical company. It might be losing millions of dollars today as it pours money into research. A standard DCF might show it's worthless, but its real value lies in the patent for a drug that's going through clinical trials. That patent is essentially a real option. It's the right, but not the obligation, to produce and sell a blockbuster drug if it gets approved. This option has a huge value. Even with all the uncertainty, valuing these kinds of companies requires thinking like an option trader, considering the potential upside if things go right, even if the current picture looks bleak. This applies to tech companies with undeveloped patents or energy companies with untapped reserves. So let's bring it all home. What is the ultimate purpose of doing all this work? It's not about being right to the penny. No valuation will ever be perfect. The future is uncertain, and our models are just simplified reflections of a complex reality. The true purpose of valuation is to provide a disciplined counterpoint to the whims of the market. The market is often driven by moods, by fear and greed. Your valuation is your anchor of sanity. When the market is panicking and selling off a good company, your valuation gives you the conviction to buy. When the market is euphoric and pushing a mediocre company to absurd heights, your valuation gives you the discipline to stay away or to sell. It's about replacing speculation with analysis. The Little Book of Valuation is not a recipe book that gives you a formula for every situation. It's a toolkit and a philosophy. It teaches you how to think about value, how to build your own story, how to test that story with numbers, and how to understand the difference between the price of a stock and the value of the underlying business. At the end of the day, a valuation is your personal, reasoned opinion on what an asset is worth. It forces you to get your hands dirty, to read the financial statements, to understand the competitive landscape, and to form your own conclusions. This process in itself makes you a better investor, regardless of whether your final number is spot on. It moves you from being a passive passenger, tossed around by market sentiment, to being the pilot, navigating with your own map and your own compass. And that is a truly invaluable skill.